Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hi friends, let us now revise another unit in the chapter Working Capital Management, that is management of inventories or management of stock. Management of inventories or stock. Now friends, ideally speaking, this is a very small unit under working capital management in financial management. Why? Because ideally you will be learning management of inventories in the subject of cost and management accounting. There is a detailed explanation and description about a lot of concepts in this unit, where you will come across like what is the minimum level of stock to be ordered, then what is the maximum level of stock to be ordered, correspondingly what is the average level, and then there is something called as reorder level, then reorder quantity, and then we have danger level, like this, because it is end of the day it is talking about management of stock or management of inventories. Therefore, you should understand all these things. Now, as I said, all these things you will anyways learn in cost and management accounting, but in financial management, under this head of management of stock or inventories, we will learn only this part, that is reorder quantity or management of reorder quantity. Now, the moment I say management of reorder quantity, what should be that management for reorder quantity? What do you think of, what do you have to manage about this? Because we are talking in financial language, what should be the management for this? Manage in the sense, what will be such quantity when we order, it is financially viable. Now, the moment I say financially viable, that's a generally understandable term, but technically speaking, or even more, to simplify even more, financially viable is least cost. Yes, definitely yes. Now, what is the technical name given for this having the least cost? Most economical. So, what will be the ordering such quantity at which the option is very economical, and hence the name here is given as economic order quantity or EOQ. So, this is what we will be focusing upon. This also will anyways learn cost and management accounting, but in financial management we will have a special focus on this topic called as economic order quantity. Now, what is economic order quantity? As we just mentioned, it is ordering such quantity, when the cost is very least, or the order such an ordering quantity will result in the least cost or the most economical cost. No, the moment I say most economical option it is, when will we say it is economical option? What are the items involved in considered to ordering quantity? First of all, what are the items considered is what you should understand to compute. Say, first item what we require is A, that we give it the name is actual requirement of stock. If A is actual requirement of stock, and if O is the ordering cost, the total ordering cost, and if C is the total carrying cost. So, ideally the two costs which are involved are one, ordering cost, and two, carrying cost. Now, these two costs are involved, but we are again saying it has to be economically viable, financially viable, most economical, meaning what? The sum of these two costs should be the least. Now, if A is the actual requirement of stock, and if O is the ordering cost, and if C is the carrying cost, there is a formula given to compute EOQ, that is economic order quantity, is equal to square root of 2AO by C. This is the formula. In our syllabus, when we learned the concepts, we saw the derivation as to how we got this formula very clearly. Now, as we are revising, we are just recapping. We will just recap the concepts. Now, what is ordering cost? How do we compute this total ordering cost? Very simple. It is cost per order into number of orders. Similarly, what is carrying cost? Cost to carry for the period. Now, in A, we will say actual requirement of stock per period. I repeat, this is per period. The actual requirement is, say, it can be 1 month, It can be 3 months, it can be 1 year, it can be 10 days, it can be 20 days, whatever. Now, what is the actual requirement of stock for the specific period is what we will consider in A. Then in C, what we will say, cost to carry per period into how much stock are we carrying. Now, what is that we are carrying is nothing but our order quantity. But what happens, conceptually speaking and logically also, whatever order comes, the entire order will not be carried throughout the period. In the beginning there will be full order, at the end it will be 0. Therefore, we say we will take an average. So, average of the quantity, ordering quantity is what we will say into cost to carry per period for the specific given period. Now, how do we arrive at this formula? We said when is the total cost least? Now, the total cost will be least when these two costs are same. That is the conceptual and technical element. Now, as I said, in detail we have it there, but here again just to recap, no, we say ordering cost will be equal to carrying cost when ordering cost and carrying cost are same. Such total cost will be the least total cost is what we have said, we have understood. We have also seen some trial and error method in our learning. Absolutely yes. Now, what is ordering cost? We said cost per order into number of orders. Now, how do we get number of orders? Let us say 10,000 units is required. That is A, our actual requirement of stock. If we are ordering say some 1000 every time, that is our order quantity. Now, how many orders will we require? Very simple, 10,000 by 1000, 10 orders. Absolutely. Therefore, how do we ordering quantity, A 10,000 in our language, what we just understood, by ordering quantity 1000. So, 10 orders. So, cost per order into number of orders will give us the ordering cost into, this is O, this is C, carrying cost into, we said OQ by 2. Now, we are trying to understand what, friends? EOQ, economic order quantity. Therefore, this is not simply OQ, this is EOQ. Now, if you rearrange this, it will be EOQ square is equal to, this is 2, no? Yeah, 2AO by C implies EOQ is equal to square root of 2AO by C. That's all. So, this is how we arrive at this EOQ, and in our examination under this topic of management of stock, what is that we will have maximum, the only thing we can have is to compute this EOQ. How do we compute? Using this formula. That's all. So, this is what we will be learning or revising in this chapter in this unit of management of stock or management of inventories. As I told you, friends, any concept for us to understand, we will have to go through the problems. So, when you go to the problems, what is that you will notice? Only this computation of EOQ, EOQ, EOQ. That's all. But before we conclude, let us write down a couple of very, very important points which are to be considered for the purpose of solving this EOQ. Now, what are the special points? Point number 1, most important point, ensure the period is common for the items. Now, what items are we referring to? That is actual requirement and carrying cost and ordering cost also. That's all three of them, because we are applying in this formula. When we are applying this formula, you cannot say, sir, annual I will take for 1 year and carrying cost I will take for 1 month. No. Either you take for everything in 1 year or everything in 1 month. Say for example, the question has given the data, the carrying cost is rupees 100 per month, and the question has given the data, the number of units required are 24,000 units per annum. Now, do not write A is equal to 24,000. One important point, why did you write? Ensure the period is common, meaning what? If it is 24,000 per annum, 1,000 units per annum is the actual requirement, carrying cost is given as what? Some 100 rupees per month. Bring the 24,000 from per annum to 1 month. That is, for 24 months, it is 24,000. Then, for 1 month, it is how much? Correspondingly, bring it down, 2,000. So, for 2,000 will be our A, not 24,000. So, like this, please ensure the period is common for all the items given in the question. Now, the second another important point is, if the data has given carrying cost as percentage, the data is given carrying cost as percentage, carrying cost per unit is, if it is not given, It is given as a percentage. Say for example, the question says carrying cost is some 5%. So some percentage of what? Is it percentage of A? Is it percentage of O? No. Don't get confused. It means it is percentage of purchase price. Whatever is, if the question is not, there is no mention about any data about the carrying cost. If the question simply says carrying cost is some 5% or 8% or 3%, that means the purchase price will be given. Say for example, purchase price is rupees 200 rupees, and if the question says carrying cost is 10%, what will be the carrying cost? 10% of 200, that is 20 rupees. That is per unit per period. That is it. And one more, another very last important point, that is in case some minimum level of stock is required, and if there is some time, there is a lead time for the stock to arrive, if such data is given, then how do we compute carrying cost? What is the quantity we are supposed to say? Carrying cost per unit we know how to compute, but what is the quantity? Ideally you said, sir, ordering quantity by 2 is what we will take. That is true, no doubt. But what happens, friends, this we said in the absence of the above points what I just mentioned, that is having some minimum level and having some lead time for the stock to arrive at. When these two are given, what should you do, sir? Then what happens? There will be a small change in the items to be considered for carrying cost. What should be the total quantity? It is ordering quantity by 2 plus minimum level minus stock consumed in lead time. I repeat, it is minimum level minus stock consumed in lead time. This much has to be reduced. Why should we reduce this? This again we explained in the main concept also. There is also one problem about this, but conceptually just to recap, see this part, it is an average, no doubt, but this part, that is this minimum level minus stock consumed in lead time, will remain throughout the year. Throughout. How much ever stock comes, how much ever stock goes, how much ever lead time is there will be some minimum level. So only by arriving at minimum level, stock will be ordered. Now by the time stock comes, this minimum level also will reduce. Definitely yes. Say for example, the minimum level is 1 lakh units, and then some order is given, the ordering quantity has to come, it will take some say some 5 days or 10 days. Now in this 5 days or 10 days, say for example, out of 1 lakh units, say some 20,000 units are consumed. Then what happens? The balance is 80,000 units. So irrespective of how much of stock is coming or going or whatever, this 80,000 will be always there. Therefore, there is no average for this 80,000 units, that will be there throughout. Therefore, friends, please understand this, whenever there is a minimum lead time given and there is a minimum level given, this will be the formula. That's all. So putting all these things in mind, directly go back to the problems and then check as to how to compute EOQ. Let us now move to another unit in the chapter of working capital management, that is management of creditors. Management of creditors. Friends, ideally speaking, of all the units in this chapter, working capital management, this is the smallest unit. And if you look at the original syllabus also, there are only just 1 or 2 problems in this unit, and that is also based on the concept of time value of money. Alright, let us now look at what is that we are supposed to understand as to management of creditors. Now what is that we are going to manage the creditors? Now when will this creditor situation come? See, you have a supplier, you are going to purchase material from the supplier. Now the supplier is giving you some offer. Boss, instead of paying now, you avail the trade credit, you pay say after some 45 days instead of today. Is there any problem with that? There is no problem. Now tell me, then what is there to manage here? The management comes not when the situations are straight. There will be some twist involved. Now, he says, boss, instead of today, you take the material, you pay after 45 days, right? This is called offering trade credit. Now the thing comes out, instead of paying now, if I am paying after 45 days, it is better no. Why, sir? Sir, if for example, I have to pay 100 rupees, the 100 rupees I will invest today, and then after 45 days, I will get some interest on it, no. If I have to pay him 100 rupees, I will pocket the interest and then pay him 100 rupees. Is it not better? Very good, better, very better, but one thing, when situation is straight. But what if he tells you, the supplier tells you, okay, I will give you 45 days credit, no doubt, but if you pay in 10 days, I will give 2% discount. That is, if you pay within 10 days, if you pay by 10th day, on the 10th day if you make the payment, you don't have to pay 100 boss, you pay only 98 rupees. Now, should we avail this offer or not? That is what we will be learning in this step. That's the only thing. Should the company avail trade credit versus not avail trade credit? The game is all about this only. Should the company avail the trade credit? Should the company accept this offer of trade credit and pay after 45 days or whatever the time the supplier has offered, or should it not avail? This is the game. This is the question. Now, before moving to the mathematical part, let us conceptually understand certain things about this. Now, first of all, when we say the term management, when we use the word management, then there is some cost involved. Now, here, is there any cost involved? The moment we say management, we always use, okay, economical, beneficial or benefit versus cost, same terms. But what is the cost here? Is there any specific cost for creditors? Now, tell me, for paying after 45 days, is the creditor charging any interest for the delay? No. There is no explicit cost, but there is implicit cost. Therefore, whether trade credit is availed or not availed, for both situations, there will be costs. They are all implicit costs. Now, what are the costs concerned with availing trade credit? What are the costs concerned with not availing trade credit? Let us see one by one all of them, and then we will move to the practical part of the solution. Let us write down one by one the costs. The first cost, the most important cost, is discount. I am talking about cost of availing trade credit. Now, if the company is availing trade credit, means what? Instead of paying now, the company is paying after 45 days. No, but then why did discount become a cost? A discount is a benefit foregone. Had the company availed the trade credit, the company could have paid less only, no? Okay, whether that less is beneficial or not, we will see in the mathematical way, but conceptually speaking, by availing the trade credit, the company is not enjoying the benefit of having the discount, not having the benefit of paying less. Yes, therefore, discount is considered as an implicit cost. Then, loss of goodwill. Sir, why, sir? Remember, friends, whenever there is delay in payment, whether the company acts as a debtor or a creditor, whatever it is, whenever there is a delay in payment, there will always be a risk of bad debt. The risk of bad debt might hit upon the goodwill of the company. Therefore, any choice of delay or delaying the payments might affect upon the risk of the goodwill of the company. Therefore, loss of goodwill is the risk. That's again an implicit cost. Then, cost of administration. That is, this is not the cost for the company directly, but because of this delay, the company, the supplier might have to incur costs. That will be impact on this the main company only. Therefore, whenever cost of admin are incurred, that is also considered as an implicit. This is not the direct cost of the company as such, but it is cost for the supplier also. Therefore, supplier will feel because of the delay, my admin costs are increasing. Therefore, these are considered as the three costs, implicit costs of availing trade credit. Now, what will be the cost of not availing trade credit? Interest rate. Now, what is interest rate? We said, the statement what we said is, if the company is availing trade credit, did the company pay any interest? No. If the company is not paying in a had, see, for example, instead of this supplier, outside if the company is charging, saying I will pay later, what will anybody say? Okay, you pay later, but you pay the interest. Yes or no? Yes. But the supplier is not saying that condition. He is saying comfortable pay after 45 days. No, therefore, if there is no cash outflow, if there is no interest payable, then what? Is it like a deemed inflow? Yeah, it is a deemed, it's not an actual, but still, is the company not losing the benefit of interest? Therefore, benefit of not paying the interest, therefore it is considered as cost. Then, inflation, interest rate, then inflation. Now, what is this inflation thing? See, friends, we are talking about not availing trade credit. Means what? The company is paying immediately. Here, the company is paying later. Here, the company is paying now. Now, see, for example, if the company is paying now, after 1 month or 2 months is what the credit offer is there. Had the company not paid now, had the company accepted the trade credit given by the company to pay after 2 months, whatever is the interest rate, inflation rate after 2 months, that is, the company is not bothered about it. Yes, because today company has already agreed, after 2 months, I will pay you at this price only. I will pay you at 100 rupees only. But what if after 2 months, the cost of the product becomes higher? Is the company not missing out on this opportunity? Therefore, inflation rate is also considered as an indirect or an implicit cost. And lastly, inconvenience to suppliers. Now, why inconvenience to suppliers? Now, suppliers may have a regular practice of giving on credit. If your company is the only company which says, no, I don't want trade credit, I will pay now only, then the policies of the supplier might get impacted, and henceforth, these are considered as the costs of not availing the trade credit. Now, let us now directly jump into the practical and the mathematical part of understanding what is cost of, or what is the management of creditors will be doing with a small example. Say for example, the same thing what we spoke earlier. Say the company is given a 45 days credit. Okay, the company is supposed to pay some 100 rupees when? After 45 days. Now, what is that we thought of? Okay, what can the company do? Okay, take this 100 rupees. I repeat, take this 100 rupees, invest somewhere. It will generate some interest. Yes. How much interest will it generate? Let us say some 25%. Okay, so what is 25% of 100 again? 25 rupees only. Okay, so it will generate some 25% of 100. So 100 into 25%, that is rupees 25. This 25 is percent per annum, friends. Correct. So this 25 rupees it is earned in how many days? This 25 rupees is for 365 days. Then for how many 45 days? What will be the amount earned? If 25 is the percentage, if 25 rupees is the interest, what it can earn, this it can earn in how many days? Actually 25 rupees is per annum, because it is percentages per annum basis, always it is given like that only. Now for 365 days, if it can earn 25 rupees, for 45 days how much can it earn? Very simple. So 45 into 25 divided by 365. So 25 into 45 divided by 365. That is 3.082 rupees. Now what will you say? Okay, therefore, now putting all this in one step, if I have to say this, how do I write this? 100 into 25% into 45 by 365 is equal to what? 3.082. Now what happened? By investing 100 rupees today at the rate of 25%, now I have to bring it down not just per annum, for 45 days. What can the company earn? It can earn an interest of 3.082. Therefore, what will the company do? Today it will invest 100 rupees, generate 3 rupees extra. It will, after 45 days, it will pay what? 100 rupees. Whatever is 3.02 which came to the company, it will pocket. That's all. But what is the condition given here? Now the company is saying, no boss, instead of 45 days, if you pay in 10 days, you don't have to pay the entire 100 rupees, pay only 98. Yes? Okay. Now tell me, should the company avail or not? This is what we'll be seeing in management of creditors. This is the only decision. What is that we said? The decision of should I avail the cost or not avail the cost. How do we decide? Now you see. Acha. So the company has this offer. Now when it says the terminology used for this is called 2 by 10 net 45. Meaning what? Ideally you have 45 days, but you pay in 10 days, I am giving you 2 rupees discount. I repeat, ideally 45 days is the time given, but you pay in 10 days, you will get a discount of 2 rupees. Now what should I do? Should I avail the discount or not? Okay. Now it is saying pay in 10 days. Now as finance persons, what we will say, should I take about first day or second day or third day? Boss, 10 days is giving time, no? Pay on the 10th day. Why lose out on these 10 days? Okay, so on the 10th day, how much are we expected to pay? 98. The same funda will apply. Same logic. What is that? Now, instead of 100, now what is the time I can do? This 98 I can invest today. I can invest today, and I repeat, I can invest 98 when? On the 10th day. If I am investing on 10th day, for how many days should I more wait? From 10th day to 45 days. How many days are there? 45 minus 10? 35 days are there. Therefore, this time my interest will be generated not for 45 days. As per this logic, if I can pay 98 on the 10th day, if I have to pay 98 on the 10th day, should I pay it or not? Okay, let me check. I will take this 98, I will invest somewhere and generate some return. I will have some opportunity rate I will get. Yes. For how many days? For 35 days. Now, what is the discount offered by the company? 2 rupees. Now tell me friends, if the company can take this 98 and invest at some rate for 35 days and it can generate an amount over and above 2 rupees of interest, why am I saying 2 rupees? Otherwise how much? 100. So if I can generate at least 2 or more than 2, no doubt for sure. I repeat, I have to generate how much in the name of interest? I have to generate so much. It is minimum. If that rate of interest opportunity if I have outside, what will I do? I will go invest there. I will go invest there, generate an amount of interest of 2 rupees or more, slightly more, and then whatever is the excess, I will pocket the difference. I will enjoy the benefit of difference. 100 I have to pay, no? I will pay. Over. So the decision of availing the credit or not availing the credit depends upon what? This rate of interest. So here instead of 100 it is 98 because I am investing 98 into some X percentage into now how many days? It is 35 divided by 365, not 45. Now it should generate how much for me? At least 2 rupees. At least 2 rupees if it is generating. Then what is beneficial? This interest opportunity, if it is generating at least 2 rupees, then outside I can invest and what can I do? I can wait till 45 days and then enjoy the benefit. Meaning what? Meaning what? Availing the trade credit. Now when will the trade credit be availed? It depends upon this interest rate. If this interest rate is able to generate more than 2 rupees for me, then what happens? Are very clear boss, I will not pay the company now. I will invest there only, I will wait for 35 days, I will get some 3 rupees say for example. If the company is getting 3 rupees, then what? Acha, very good. I will, now 3 plus 98, total company has 101. But the company has to pay how much on 45th day? 100 only, 1 rupee profit, enjoy the profit. Therefore, now what is X here? How do we compute? Therefore, X percentage is equal to 2 by 98 into 365 by 35. Let's compute this. So 2 into 365 divided by 98 divided by 35. That is 0.2128. Therefore, X will be, this is X percent, X by 100. Therefore, X will be 21.28%. Now, mathematically, what do I do? Okay, so X is equal to 21.28% means what? Outside, say for example, now this is what? This is the minimum rate expected. Minimum rate expected. Outside, I have an opportunity, the company has an opportunity of earning 25%. Correct? No, this is 25% is actual, this is the expected. If actual is greater than expected, very good. Don't pay the company now. Go, invest, earn 25% and pocket the difference. Outside, the offer is there only for some 18%. Now, if there is only 18% offer, what happens, friends? See now, whatever 98 is there, the same formula we will use. The same formula we will use. What will you do? 98 into 18% into 35 divided by 365. What is happening? It is 1.69. Is it able to generate 2 rupees? No. 98 plus 1.69 is 99.69. Again the company has to pay extra. Why? Instead of putting outside, I will avail the credit. I will take the discount. I will enjoy the benefit of discount. No, if the company can generate more than 21.25%, say 25%, what we just did now. So 98 into 25%, 24.5 we got it, into 35 divided by 365. Now, that is giving 2.349, that is giving 2.35, not just to 35 paise, for every 100 it is giving extra. That is all the profit. Therefore, if the actual opportunity cost outside is over and above this minimum expected rate, then the company can delay, the company can avail the trade credit If it is less than this, okay, the company shall not avail the rate credit, it can go for opting for discount and paying within 10 days. So this is how mathematically we will be making a decision with respect to management of creditors. Now friends, this is mathematically we have seen. To give a small formula for this, what do we call this? What is this 2? This 2 is nothing but discount. Then what is this 98? Nothing but 100 minus discount. Then 365 only, that's always number of days per annum, by what is this 35? It is called as T. This T is nothing but the difference between the date of discount and the complete trade credit period. This difference is called as, that is 45 minus 10 is called as T as per the formula, and this is what, whether you by heart the formula and do, or logically we have just seen how to do it. This is how we compute the minimum rate, the minimum opportunity expected rate of return, based on which, I repeat, based on which if the actual rate of actual opportunity available is more than this minimum rate, then avail the trade credit. No, actual is less than this minimum rate, then avail the discount. Let us now talk about another important unit in the chapter of working capital management, that is treasury and cash management. Treasury and cash management. Friends, in generic terms, usually this treasury and cash management are used interchangeably. That is, people call it either treasury management or cash management, but to be precise, to be clear, cash management is one of the functions of treasury management. So now as we see the functions of treasury management, then we will understand definitely the bifurcation between these two. But before that, before going in details about these two, let us understand one very important point. From the examination point of view, if you ask me, sir, what is the most topic or concept in this treasury and cash management unit, means, as you all know, it is cash budgeting or preparation of cash budgets. But before entering into the heart of the topic, let us also quickly revise in a nutshell certain theoretical aspects concerned with treasury and cash management. Firstly, let us talk about treasury management. Now, what is treasury management? As we all know, it's management of treasury. Now, the first thing is, what does treasury management talk about is what we are supposed to understand. See, it mainly talks about the policies and strategies to minimize three major risks. What are the three major risks? Or to address these three major risks, that is the liquidity risk, the financial risk, and also the reputational risk. So it is treasury management is concerned with the strategies and policies to minimize these three risks or avoid these three risks. Now, why are these risks? Why do they come into picture? Because of, again, three more important reasons. What are the three important reasons? That is volume of transactions which happen in a company. That is the first reason. Secondly, the interest rate fluctuations. And lastly, the volatility in forex market. The volatility in forex market. Therefore, if you understand, friends, treasury management is not something which deals only with working capital management. It also deals with interest rate management and forex or foreign exchange management. Now, what are the targets of treasury management? If you ask me quickly, there are few important targets. That is, all we know, that is minimize the cost of borrowings, maximize the return, return of the cash available, and mobilize funds with respect to the needs of the company, and effectively deal with this commodities, interest rates, and forex to avoid all this risk. So these are the main targets of treasury management. Let's now look at what are the functions of treasury management. Key functions of treasury management are cash management, then forex management, then fund management, then banking, and lastly corporate finance. Now, Let's look at one by one all these items. But again, as I said, our main understanding is about, main focus will be next on cash management only. Now, what is that we understand about cash management? Management of cash. Now, what is the meaning of management of cash? As we said, as we have been seeing in finance, we always have a trade-off between two things. In cash management, in general, you have a trade-off between benefit or cost, a return, actual return or expected return like this. What is the trade-off we'll be seeing in cash management? Was how much cash should I have? Should I have more cash? Should I have less cash? Now, there are problems with both things. Which is less problematic is what we'll understand finally, or how to technically and strategically address this problem. Now, what if you have more cash? Funds are more, idle funds are more. Unnecessarily we are losing on the opportunities. Okay, what if we have less cash? There's a liquidity crunch, okay, there's a cash crunch, then there's a liquidity issue, there's a goodwill issue. So like this, there has to be a management between how much cash has to be ideally maintained by the company, by the management. That is cash management. And also, what are the systems, centralized system or decentralized system of management of cash, like this. Then, forex management. Now, what is forex management? When will the occurrence of forex management come into picture? Because when the company has transactions in various countries. Now, the company need not have only suppliers. Even if the company has branches in other countries also, there can be methods in which the forex, volatility in forex can be minimized. The risk of forex, risk that can be minimized, that happens through the forex management. Similarly, fund management. What type of fund? What should be the timing of fund? What is the nature of the business? What will be the timing? What will be the time required for the company to generate revenues or recover or be able to pay the loans? So, depending upon the nature of the business, type of the business, the cost has to be decided, the structure has to be decided. All this fund, how the fund is generated will happen through fund management. Then banking. Again, now banking is not just about dealing with money, friends. Now today, banks have become so very important even in individuals' lives. Then in such case of companies, it is even more important because there will be a lot of documentation work, a lot of licensing work, a lot of approvals. For all these things to happen, bankers should have a very harmonious relationship with the companies. And lastly, again, corporate finance also, there are, apart from the regular activities happening in a company, there will be some special activities like acquisition and divestment like this. So for all these things, the management will play a key role in the form of treasury management. Let's now move to the next important part, that is cash management. As you said, the heart of this topic, that is cash budgeting, comes under cash management only. Now, what type of cash will we have to manage under this segment? That is, we will have to manage all cash inflows, then all cash outflows, then cash within the firm. Cash within the firm. Now, what type of cash inflows? It can be through any form. It can be by raising shares the company may get, or the company has invested somewhere and they have paid some dividend. Yes, that also comes here. The company has sold some asset. Yes, that also comes here. The company has generated a revenue. That also comes here. So, in whatever form the cash has flown inside, that cash has to manage. Similarly, cash outflows. The company has purchased some asset. The company has purchased some new shares, invested in some marketable securities, any form of cash outflow, and also the cash within the firm. What is the main objective of cash management? The most important objective of cash management is to ensure adequate cash balance, at all times. Now, the company, based on the operations, based on the regular budgeting, once a company makes a basic budget, it will have to have an understanding as to what should be the adequate balance to be maintained. Now, what happens if the cash, if there is any deficit, then what happens? So, if there is surplus, then what will happen? If there is a deficit, what will happen? If there is a surplus, in case of surplus, then what will the company do? The company will invest. If there is a deficit, two things the company can do. It can, if there is some surplus investment, it can sell that and generate some funds. So, sell the marketable securities or borrow and get back to the company. Therefore, friends, it is the most important objective of the cash management is to ensure adequate cash balance at all times, and also to ensure funds are not blocked. Idle costs are not incurred, funds are not blocked, and they are properly invested based on the depending upon the balance. Now, how to estimate this cash balance? Again, how to estimate all these things? As we said, we will then have to move into the most important area, that is cash budgeting. Now, before we get into the cash budgeting aspect, let us also understand one small important concept here, that is called the need for cash. Need for cash. Now, what type of need are we talking about? We are talking about the transaction need, the speculation or speculative need, transaction need or speculative need, and lastly the precautionary need. Now, what are the transaction needs? To be quickly revise this, transaction is nothing but the needs which the company has to address on a daily, day-to-day, regular basis. Therefore, whatever for the operations the cash is needed, they come under the category of transaction need. Speculative need, now we in the other chapters we also spoke about some 2 by 10 net 45. That is, the company can pay in 45 days, but if there is a discount offered of 2% to pay in 10 days, should the company do it or not? That we have seen, we will see it in the chapter of creditors management. Now, in such a case, if the company decides to avail the discount, then what should the company have? It should have cash. This is a speculative need. It's not readily available. It's not planned. First of all, suddenly the trader gives an offer like this. So, it's a speculation. If there is a need for cash, such category falls under speculative need. And lastly, precautionary need. This might come up in case of any emergency, very unforeseen conditions. There may be some strikes or there's lockouts or some natural calamities, because of which even if the functions, the company does not function, there is a stoppage of all the activity of the company. Even then, the company needs such need for cash falls under the category of precautionary need. Let's now move to the next area, the most important area, that is cash planning. Now, what is this cash planning? Cash planning is nothing but the estimation, the projection of a cash statement. Cash planning is nothing but preparation of a projected cash statement based on the expected cash inflows and cash outflows. I repeat, cash planning is nothing but preparation of a cash statement based on a forecast of the cash inflows and the outflows. Now, how is this cash planning done? Majorly, there are two techniques. One is cash flow statement, and the second one is cash budget. So, preparation of cash budget. Now, cash flow statement, this method you will be separately learning in detail in your subject of accounts. Therefore, we will not talk about it at all. There is a detailed explanation about various items in cash flow statement, what are the how do you prepare a cash flow statement and all that stuff. Therefore, there is no focus about cash flow statement in financial management. Also, from examination point of view, also the most important topic is preparation of cash budget. Now, how is this cash budget prepared? Again, cash budget can be prepared in three ways. One is receipts and payments method. Next is adjusted income method. Next is adjusted balance sheet method. Now, again, of all the three, the most popular and the one which is required for our examination is receipts and payments method. In receipts and payments method, what happens is we will list down all the cash receipts, all the cash payments as per the cash budget period required. So, whatever is the targeted budget period we are talking about, be it 1 week or 10 days or 15 days or 1 month or 3 months or quarterly or half yearly or 1 year, whatever it is, for that period, what are the expected cash inflows and cash outflows. Again, based on the language of the question, language of the data provided, how are those cash flows, what is the timing of the cash flow, cash inflow or outflow. They are segregated, and finally we prepare the net cash balance to be estimated. That is one. Coming to the adjusted income method and adjusted balance sheet method, as we said, it is not very popular and it is not considered for our examination point of view. Also, there are no problems also in our syllabus about this. In adjusted income method, what happens is the revenues, the sales revenues and the costs are adjusted for the delay in payments and receipts. Whereas in case of adjusted balance sheet method, what happens is the items of the assets and the short-term liabilities, they are expressed as a percentage of sales. That's all. So now our main focus is on the receipts and payments method under the topic of cash budget. So friends, as we said, cash budget is the most important here. Now, why is cash budget the most important? Because it is only through this cash budget we will understand as to how much, what is the cash inflow, what is the cash outflow, what is the timing of the cash flow. That is also very, very important. Finally, to understand whether the company has a surplus or a deficit of cash balance. Now, depending upon the requirement, if there is a surplus, the company can invest in marketable security. If there is a deficit, the company can sell those marketable securities or can borrow and move ahead as per the cash planning to be made. Now, in preparing cash budget, friends, there are certain very important points to be remembered in our mind. What are they and how are you supposed to prepare the cash budget is what let us see now. Now, points to be noted while preparing cash budget. Friends, understand, in preparation of cash budget, the most important point is the language of the data provided. I repeat, the language of the data provided is what the only tricky thing you will have in this. There is no mathematical trick at all in cash budgeting or preparation of cash budgets. It is all the language with which, usually students get confused as to how to arrive, how to compute, how to break up and all that. For that, let us see certain important points. Firstly, identify the period of cash budget and identify the items falling in the purview of the cash budget. Now, what is the cash budget? Now, the question may say the period is for Jan to March. Now, the data may be there from November to April. But what is the budget period required for the question? When it is Jan to March, identify. Now, you may write from November to April in the working note. But in the final cash budget, the actual period only has to be mentioned, and what are the items falling in that period have to be mentioned. Therefore, identify the period of cash budget and identify the items falling in that purview. According to the information given, how are we going to break up? Say, for example, credit sales is there, out of which some percentage is collected in next month, after 1 month, some after 2 months. Now, if the sales are made in December, and if you are talking about Jan to March, the cash budget we are preparing, then if you say 60% in after 1 month and 40% after 2 months, then after December means what? In January 60% will be there, in February 40% will be there. Now, of Jan in Feb and March, of Feb 60% will be there in March, but 40% will be there in April. That is not under the purview of the cash budget, therefore that can be ignored. Like this, whatever falls has to be identified carefully and then accordingly has to be written in the whether receipts or payments column, because we only have two categories, cash receipts and cash payments, or cash inflows and cash outflows. Next, how much is for credit and how much is for cash? This is again very important. Now, the question will give us some data. The question may say some cash has been generated, some sales have been made, the revenue is so and so much. But say if out of 10 lakhs, the question may say 2 lakhs is out for cash and the balance 80% is on credit. Therefore, 2 lakhs is for cash means if the question is silent about it, about the collection, it is collected immediately. Then, out of the credit, how much is for cash and how much is for credit? The next point is, of the percentage of credit, what percentage received and when it is received. So, this is also very important. As we just mentioned in the earlier example, in understanding the period of the budget, what percentage is it? 30%, 20%, 15%, what and when? That is not just the amount, also the timing is very important. Now, whether it is credit sales or credit purchases, if it is credit sales, we will have cash inflow, if it is credit purchase, we will have cash outflow. Therefore, of the information given, you may purchase materials or you may make some payment for overheads or wages, whatever it is. What is paid when is very important. Look at the language of the question very carefully. Say in some of the questions, if you remember in what we have solved, when you see, these are all things which you will understand better only when you look at the problems. But because as we are revising, I am just trying to put them in a nutshell and make you understand. Now here, what is it we are trying to do? Understand the language of the question. Now, when are the goods produced? Okay, they are produced in so and so time. So for which what is the payment made? When is the payment made? How is the payment made? That is also very important for us to understand. Done. So this is about this point. Now, placement of periodical cash inflows or outflows. There are not everything happens on every time. So sometimes, even though it is for Jan, Feb and March, some payments may be periodical. Say for example, some debenture falls only in the month of February. Say it is a quarterly payment, of which only one falls in the interest falls in February. Oh, that we will write. Taxes are paid only in 1 month, which falls advance tax is paid. It's a specific payment. Therefore, those payments have to be given a special focus. Then, computation of cost first and then timing of payment. Now, at times what happens in the questions, in the data what is given to us, the language will be very tricky. The question might say, the payment is made 2 months after production. 2 months after production, and there is an increase in cost from 4 rupees to 5 rupees. Now, friends, the order will be like this. The timing of payment will be given first and then the cost will be mentioned. But remember, first compute the cost and then only the timing of payment. That's again a very important point. Then, how to understand the status of the current assets and current liabilities, whether they decrease or increase. Now, in case of decrease in current assets and increase in current liabilities, it means increase in cash balance. I repeat, decrease in current assets, this point we are talking about, decrease in current assets and increase in current liabilities. What is decrease in current assets? Debtors have decreased. Yes, there is an inflow of cash. Similarly, increase in current liabilities. Okay, you have borrowed some money. Yes, cash inflow. These two increase the cash balance. Correspondingly, vice versa, exactly opposite, that is decrease in current liabilities and increase in current assets. Decrease in current liabilities. Whatever current liabilities are there, whatever payables are there, they have decreased. Means what? They have been paid, therefore cash balance reduces. Again, increase in current assets. Say for example, current assets have increased, stock has increased, means what? New stock has been purchased. Therefore, please be very careful in understanding this. This area looks slightly confusing, but please have a cautious thought here. Has to decrease in current assets or increase in current liabilities will increase in cash and vice versa. Then, at times the data of the cash collected from debtors is not directly given to us. Some opening data will be given, some closing data will be given, and credit sales will be given. Then how do we use? Same thing. Collection from debtors will be opening debtors plus credit sales minus closing debtors. That is, for example, opening debtors are some 10,000 rupees, credit sales are made are some 50,000 rupees. Therefore, totally 60,000 have to be sold. But there are some closing debtors of say some 30,000 rupees. Means what? Out of 60, only 30 are sold. The balance 30 are, they will become the opening debtors for the next period. So like this. Similarly, even for cash payments also. How will we compute the cash payments? Opening creditors plus credit purchases minus closing creditors. But even at times when purchases are not given, we know also the formula. Opening stock plus purchases minus closing stock is equal to cost of sales. With the help of this, we will find out purchases. That is cost of sales plus cost of sales plus closing stock minus opening stock. So these are a few very important points which we are supposed to keep in mind while preparing a cash budget. Let us now understand another small important concept, that is the concept of float. Now, in our financial terms, what is the meaning of float? Float refers to the delay or lag in the happening of a transaction. That is, a transaction must have happened, but it has not happened completely. That is, it has not turned into the form of cash. When there is such a delay in the event of transaction happening, but not yet turning into cash, is called as a float. That is, the lag refers to this float. Now, to understand this float in our financial terms, let us take a small example. Say I am a company. I have purchased goods from some supplier company. So, and they have sent me the goods. The moment they send the goods, will they get the cash from me? Will they get the payment? No. They have sent goods, but they have to prepare the invoice? Yes. The time taken between the goods sent and preparation of invoice is called as the billing float. Okay, the bill has been ready. Okay, now will they get the money? No, they have to send the bill to me. No. Okay, they have to send the bill. Now, the seller who is selling the goods should also send the bill. Therefore, the time taken between the invoice prepared and for him to send it, that is for me to receive it, I am being the buyer, the time taken is called as the sender's or the seller's mailing float. Therefore, there is a mail float. Mail refers to what? It refers to the bill being sent from one place to another physically. Now, we know what is email, but in olden days they were sent physically only. Therefore, the time lag between the invoice being prepared and being sent and to be received by the buyer is called as a seller's mailing float. Now, okay, fine, my company has received that invoice. Now, what did my company do? I am sending the check. Now, he is sending the invoice. Now, I am sending the check. Now, the moment I give check, the moment I write the check, will it turn into cash? No, I have to send it physically again. Therefore, the time lag between I sending and the supplier's company receiving this check is called as the buyer's mailing float. Okay, he has received the check. Did he get the cash? No. He has to go and put it in the bank. No. He has to process the check. No. For that, he has to go to the bank. That is called check processing float. Acha, he has put it in bank. Over. He got cash. No. The bank will take some time. No. There is some process which has to happen. The banks have to update with the RBI and then get the final approval done, and then only when things are clear, the check gets realized. Absolutely, yes. That is called bank processing float, and only then finally my supplier will receive the money. So, there is a huge gap between the goods being sent and the cash being received. Such time lag in different phrases is given different names in the form of float. Friends, let us now look at the last area to revise in this from examination point of view. This is also little important, that is our optimal cash balance models. Now, what is optimal cash balance? How much of cash balance has to be maintained by a company? Now, in cash budgeting, you will definitely see how to arrive at computing the cash balances mainly with the receipts and payments method. Now, here we will compute this optimal cash balance using certain techniques. What are two techniques which are included in our syllabus? One is our William J. Baumol's EOQ model. Now, what is EOQ? We have studied very well in the syllabus, that is economic order quantity, which we see in the debtors management, inventories management, that is management of stock. Again, there is a detailed understanding of this concept also in your cost and management accounting. So, let us not go too much of detail into this now. The only thing what you are supposed to understand, whatever is the EOQ, that is economic order quantity there, it is optimal cash balance here in our cash management. Now, here what is the formula of EOQ? Square root of T O2AO by C. Now, there A is the annual requirement of stock. Here it is annual cash requirement. Here A is this. Now, there 2AO, O is the ordering cost. Here it is transaction cost. There by C is carrying cost. Here also carrying cost, but it refers to the opportunity cost, that is the interest cost, that interest rate. Therefore, using this formula, we can understand and compute the optimal cash balance using William J. Baumol. Now, there is one more method that is called Miller-Orr model. According to this, there are three levels. 60,000, say for example, in the given picture, say 60,000 is the basic minimum required cash balance to be maintained. Now, if the cash increases, if the cash surplus increases up to 1 lakh, then do nothing about it. Keep waiting. Maybe the company has a cash requirement of 60,000 plus or minus slightly. Now, the moment it touches 1 lakh, if you notice, the moment it touches 1 lakh, it again directly falls to 60,000. Means what? 40,000 worth securities are invested, worth cash is invested in marketable securities. Immediately, the moment it touches 1 lakh, now not just 10,000, 20,000, 40,000 is now directly sold and invested, sent for investing in marketable securities. Now, what is the cash balance now? Again 60. Now, should you do something about it? Don't do anything, just wait and see. Now, after a point of time, it is coming and touching 20,000. The moment it touches 20,000, now bring it up to 60,000 level. How? Either by selling those marketable securities or by borrowing if required. Now, again it went up, 60 became 70, 75, 78, 70, 80, nothing to do. Now, 80 became 60, 80 became 55, 80 became 40, nothing to worry. Now, 40 became 55, 40 became 65, 40 became 75, 40 became 90, 40 became 1 lakh. Again sell and come back to 60,000. So, this is a way of practice of companies. So, this is about our Miller-Orr model, and this is about the unit of treasury and cash management. Friends, let us now move into another important unit under the head of working capital management, that is management of receivables or management of debtors. Now, what is management of debtors or management of receivables? So, basically friends, the company, say our company in which we are working, they must have proposed some existing credit policy for their customers. Now, say some 30 days of credit period has been already been given. Now, the management of debtors happens in various situations. What are the situations? We will bifurcate the situations into different policies, that is credit policy and then discount policy, and then lastly we will also see what is how is factoring done. Now, from our examination point of view, these are three important models what comes in our unit of debtors management or management of receivables. Now, first of all, which is a better option? Again, what do we say which is a better option means? What is a financially viable option? Now, when we say financially viable option, what should we write down? We should write down what is our benefit, what is our cost. The same thing we will see. Let us now conceptually look at the credit policy model of problems. Here, what happens is, we have a benefit of, there is an existing policy, there is a proposed policy. Say 1 month is the existing credit period. Instead of 1 month, is it better to offer 2 months or 3 months? Now, why will the company increase the credit period? No, only one reason. There could be increase in sales. Now, if somebody tells you, boss, instead of paying in 1 month, you pay after 2 months or 3 months like this, definitely there is a possibility of increase in sales. Yes, that is the benefit part. Then what is the cost involved in this? There are so many costs involved in this. What are those costs? The first cost is cost of bad debts. The higher and higher is the time, there is a risk of bad. That is the first cost. The second cost, that is the collection or administration cost. Now, the more and more time is given, obviously there will be a risk of bad debts, as we said. Now, to reduce the risk of bad debts, we will appoint somebody to make phone calls. We will keep on sending them reminders. We will have to send persons also at times. Now, this is our collection or administration cost. The last and the most important cost, that is the opportunity cost. Now, why am I saying is the most important cost? Because mathematically when you see, you will understand the role of opportunity cost. Now, what is this opportunity cost? Now, friends, if I get money, say for example, in 1 month versus I get money after 2 months, 2 more months, am I not losing some interest on this? Definitely yes. Are my 100 rupees today is not equal to 100 rupees after 1 month. Why, sir? Because this 100 can give me some interest. If I have some opportunity, I can invest it somewhere else and generate some more money. But am I not losing on that? Yes. Therefore, this is though not an explicit cost, it is an implicit cost though. It is still a very, very important cost. Instead of 1 month, you are delaying by 2 more months. Definitely it is considered as one of the most important costs. And to tell you even more clearly, friends, when we make the computations or we make the decisions whether benefit is more or cost is more, mathematically what we will do, you will see the problems. Anyways, in the problems we have done earlier, that is, we will put all explicit cost on one side. That is, though bad debts and collection costs are costs, though they are not benefits, we will write them along with the increase in sales and then compute profit. So, the revenue, the sales minus this administration cost and bad debts will arrive at profits, or the total cost whatever is there we will put here. These are explicit costs. Versus we will look at opportunity cost and then conclude if benefit is more than cost or not. Therefore, our game of management of debtors deals with existing policy versus proposed policy or policies. That is, if there is one policy, we will compare these two. Then if there are more than one policies, then what should we do? Boss, not just benefit versus cost. Benefit minus cost, if you call it net benefit, not just that. When there are more than one policies to be proposed and then checked with, not just net benefit, the incremental net benefit will become the deciding option. So please put this in mind. As I said, all these things you'll understand better only when you look at the problems. But just as we are in the revision part, for us to conceptually revise once again, what are our benefits, what are our costs, and how do we compute this benefit minus cost, or compute the net benefit and correspondingly the incremental net benefit. Now let us move down. See, mathematically this is what we do. What is that we do? As I just said, in benefit side we will write the explicit cost, that is, we will write the sales and we will write the total cost. Sales and we will write the total cost. The admin cost, the total cost comprises of cost of materials or cost of overheads or whatever, what all costs are included. They are all included here to arrive at the incremental profit. That is what we are supposed to see. That is the net benefit because of this decision of increasing the credit policy. Yes. The total cost included, the variable is included, fixed is also included, both are included, and then we also combine the admin cost and the bad debts to finally arrive at the profit. Not just profit, we will also compute the implicit cost. That is, we will compute the investment in debtors. Now, what is this investment in debtors? Say for example, now first point to be put in mind, whenever we compute investment in debtors, if you remember in working capital management or estimation of working capital, when we computed investment in debtors, we did not take that on the sales component or the credit sales component, we took that on total cost. Here also our investment in debtors will happen on total cost only, or the cost factor only, not on the credit sales, because we are comparing cost versus cost. We have to see the net benefit. Therefore, right here we are not taking on the credit sales, we are taking investment debtors on the basis of cost only. Now, what is the opportunity cost? It is not investment debtors, friends. Say for example, our 12 lakhs is the basic total cost, but the cycle, the debt collection period is say for 3 months. Therefore, there are 4 cycles. Therefore, what is it we are losing on? 12 lakhs is not we are losing on, because of the cycle of 3 months, there is a delay. See, end of the year, even if 3 months is not given directly, 12 months is given, whether it is 3 months or 12 months, all 12 lakhs is expected to be realized. But the only thing is, there is a cycle of 3 lakhs. Therefore, our opportunity cost rotates on this cycle of 3 months, 3 months, 3 months, 3 months, like this 4 times. If it is 6 months, 2 times. Yes, absolutely. Now moving ahead. Now this return on investment debtors is not our cost. The percentage of return of this investment of debtors is our opportunity cost. We have a detailed explanation about this in our conceptual learning. So go back there again for detailed explanation. But here, as we recap the concept, that is what is our opportunity cost? It is not just our investment debtors. It is not in fact our investment debtors. It is our rate of return of investment debtors, the percentage of return. Now, investment debtors is for a specific period. It is 1 month or 3 months or say in weeks, whatever it is. Correspondingly, this rate also we will write for that period. But our profit is computed for what? For per annum. Therefore, we will multiply with the number of periods to arrive at the percentage per annum only. So here our investment debtors, how is it computed? Total cost by number of cycles, or total cost divided by 12 months by credit period. What is 12 months by credit period? Nothing but number of cycles only. Therefore, what is the other way of writing this formula? Total cost into credit period divided by 12 months also gives the same investment debtors only. Now this multiplied with percentage per annum. Now why am I saying this percentage per annum? To avoid confusion. Some people may think, some students may think that, sir, this is per period. No, here also should take per period. Yes, we have taken per period only, but we have multiplied with it number of periods to arrive at per annum. We have to compute here on the basis of per annum. Therefore, at one shot what we will do, the investment debtors whatever we have, we multiply with the rate of interest, rate of return per annum to arrive at our opportunity cost. This is our computation. Now we will have the benefit, we will have the cost. We will see whether there is a benefit over cost or not. If there is a benefit over cost, we will call it as net benefit. Now there ends the game. But one special point here. Some approaches, sometimes if the total cost is not given, only variable cost is given, don't worry, because fixed cost is anyways fixed. In the problems, we have, when the data is separately given to us like this, we have done problems based on separate computation of variable cost. Also, there was no harm. There will not be a problem in the difference of decision making. Therefore, if the data does not provide the fixed cost information, it gives only variable cost, do not worry. So what is the only change? Instead of total cost, here we will write variable cost. If we write variable cost, we will not write profit, sir, we will write contribution. That's totally difference. Now here we are taking variable cost. In such case, here also we will take variable cost only. Again, the rest of the formula, that is into credit period by 12 months. This is our investment debtors into percentage per annum will give us the opportunity cost or the return on investment debtors, which is our opportunity cost. So this is how we see. Now let us now look at certain important points to be considered while solving the benefit cost analysis in this topic of management of receivables or debtors under the concept of credit policy. What are those important points? Let us just look at. Do not decide based on benefit alone or not even on net benefit. I just mentioned this point. Again, I am re-mentioning it because it is very, very important. In examination, what happens at times in the spur of moment, we think that a benefit is there, benefit is higher, therefore it is a better option. No. Decide not just based on benefit, decide based on net benefit. No, not just on net benefit. Decide based on incremental net benefit. So for this to understand, again go back to problems, you will understand this better. Then this point is done. The next point, do not think higher the delay, higher is the benefit. Never. Now what happens? Higher the delay, there is definitely increase in sales, but corresponding there is also costs. Therefore higher the delay does not mean higher the benefit, friends. Compute the costs also. That is why we said cost is the game changer. Therefore higher the benefit, higher the delay does not only mean higher is the net benefit. No. Again, what should we compute? The incremental net benefit to arrive at the decision. Then, do not think increasing the period is beneficial. At times, even lesser period results in higher incremental net benefit. There is again a problem for this. So just don't see, friends, we are talking about debtors management. Doesn't mean only increase in time is beneficial. No. At times, decrease is also beneficial. Who knows? Compute the numbers. Only numbers will decide. Therefore, based on the data given, we will compute the benefit and cost. Again, we will compute the net benefit. Again, we will compute the incremental benefit, and then only we will take a call. But the only small change, why I am mentioning this point here is, in case of decrease in this debt collection period, there will be a slight change in our mathematical computation. What is that, sir? In case of debt collection period is reduced, then the return on investment debtors has now what happened? Decreased. If the return on investment debtors has decreased, is it now a cost? No, it is now considered as a benefit. If there is decrease in the credit policy, will the bad debts increase? No, they will decrease. Therefore, they are also considered as a benefit. Then what is the cost, sir? Only the increase in admin expenses. Any other specifically mentioned cost, if there is an increase, only then they are considered as costs. So anyways, you know the golden rule. Cost is considered to be a cost when there is an increase in the cost. A reduction in cost is considered as a benefit only. So as I said, for this model also there is a problem. Therefore, this is how, as per the credit policy method, we will solve based on the benefit and cost and arrive at the net benefit. No, not just stop there. We will compute the incremental net benefit, and whichever option as per the given policies exhibits the highest net incremental benefit will be considered as the best policy. Now, the next concept in this unit is discount policy. Now, what happens in discount policy? The company is offering discounts and the customers, they want to avail the discount or not avail the discount. In such case, what happens? Now, when are you giving discount? We said, friends, there's a terminology, say for example, ideally you give 2 months time. But instead of 2 months, if your customers are paying in 1 month, you will say, okay, I'm giving you some 20% discount. Now, if you pay in 1 month, I repeat, if you pay in 1 month instead of 2 months, 10% discount is given. Now, the moment I say this, the first and foremost important point what we are supposed to recollect, just before in the earlier concept we said, when there is a reduction in the debt collection period, the decrease in return on investment in debtors will become our benefit. Same thing, absolutely yes. Then what is the cost, sir? If the discount is availed, are we not losing that money? Absolutely yes. So, if the discount is now, will everybody avail the discount? We do not know. Maybe not 100%, only 80% may avail the discount. All right. Maybe 50% may avail the discount. All right. Maybe that much amount is only lost. No, not the entire amount is not lost. Therefore, the discount into percentage of people who are availing this, which is the amount lost by giving the offer, is called our cost under discount policy. Therefore, again same here. We will understand, we compute the benefit, we will compute the cost. Benefit is more than cost, then it is good, then there is net benefit. If there are different options for it, incremental net benefit will give the highest option with the highest, the option with the highest incremental net benefit will be the most suitable. But in our problems what we have done earlier, we have done with only one policy, but in examination, we know the concept, how to define benefit, how to define a cost. Therefore, based on this we will define. If there is only one option, we will see whether there is net benefit or not there. If there is more than one option, what we will do, as I just mentioned earlier, we will compute the incremental net benefit based on this conceptually and then come to a conclusion as to which option is the best option. Friends, let us now move to the last concept, another important concept in this chapter of management of receivables, that is factoring. Friends, what is this factoring? We have a detailed explanation about this conceptually when we learned the subject, but let us quickly recap. Now, what happens for a company to avoid bad debt losses and to avoid all the administration costs and all this headache, what the company does is when a person called a factor comes, a firm called a factor comes into picture, he says, boss, don't worry about all these things. I will pay you the amount what you are supposed to receive from your customers. Is it not a good news? Definitely yes. Therefore, he will accept for it. Now, there is no picture without any twists. Therefore, like that what happens, factor says, don't worry, I will give you. He will say, I will give you, but he will again put some twists. Now, again, conceptually speaking, what will we do? Even in the decision of factoring also, we will write down what are the benefits and what are the costs. Now, how does the factoring cost happen? What is the process of factoring happen? Now, when the factoring firm comes, he tells you, boss, he says, for your account receivable period, whatever it is there, whatever is account receivable, I will pay you that. Now, because of this, what happened? First thing what happens is, there is a savings in administration cost. You don't have to incur all that cost. Yes, that's a benefit. Secondly, there is savings in bad debts. Yes, these two are straight away categorized as benefits. Then what are the costs involved? There are two costs. The first cost is the commission for a factory. You know, he's doing some service. Is he not expected to charge some commission? Definitely yes. That is the first cost. There is a second cost, that is interest on advance payable. Now, what is this? This is a very special point. That is interest on advance payable. What is this interest on advance payable? How do we compute? He did not say advance payable. Advance payable is not a cost. He has to pay the advance. Now, he says, boss, before paying the advance, let me tell you something. I have to pay you some amount, some account receivable I have to pay you. But from that, I will reduce some commission also, he will say. So, therefore, he is not paying the entire amount. He is reducing some amount and then paying us some net advance. Now, what is the net advance? Let us compute. Net advance payable by factor. Account receivable minus factor reserve. He will say, let me reserve some 10%. No, he doesn't say, I will not pay you all this. I will pay you, but give me some time. Now, by the time the complete cycle is over, I will make you the payment. But as of now, for the time being, some percentage let me reserve. Okay, done. Agreed. He says, tomorrow later he will pay. Therefore, fine, agreed. Then factor commission, the same commission, the cost what we thought. Therefore, yes, the same figure, the same commission comes here. That is the cost. Now, okay, factor reserve over, factor commission also over. Okay, advance payable is ready. No, you will say, okay, pay that amount. No, factor is what? Wait. No, I will pay you some advance, no doubt. But tell me, when are you supposed to receive this account receivable? Say, after 3 months. But I am paying you now itself, no. I am not charging you the interest cost on the entire amount. He says, I will not pay you the entire amount, some interest on this advance payable. Now, this interest is what? Not per annum. it is interest for that specific period. If the debt collection period is 3 months, for 3 months what is interest? If debt collection period is 2 months, for 2 months what is interest? Like this, correspondingly he will compute the interest, he will reduce that component and pay the net advance and pay this advance. But now we are talking about not this advance, this will come to the company, no doubt. What is the cost involved for the company? Achha, again this also is going out indirectly, he is losing on it. Therefore, this interest payable is considered as cost. Now game is over. You have total benefits, you have total cost. Now, check the benefit, total benefit. If it is more than the total cost, the factoring option is viable, financially viable. No, the cost is more than the benefit, the factoring option is not at all financially viable. That's all. So, this is how we make a decision based on factoring. Friends, as I told you, once again I repeat, not just factoring, be it any concept in the entire syllabus or in any subject for that matter, revision helps out not just theoretically but also practically. Therefore, going back to problems and revising these problems and then going back to them and then redoing, only then it will add value. So, therefore, please do go back to all the problems and based on the revision what we have done, kindly recheck and then try to re-understand the concepts.